the startup battlefield. So this next panel is, we couldn't come to New York without talking about what it's like to start a company in New York and what the state of seed capital is in New York. And so we brought together, some of the most active and vocal New York seed investors that we could find, as well as, two of them are also entrepreneurs, so they talk at it from both sides. So if the panels could come out now, we've got John Borthwick, who is the CEO of BetaWorks, and hello, John. Thank you for coming. Chris Dixon, CEO, founder of Hunch, and also the founder of Founder Collective, which is a seed capital firm here. Chalak Jobanputra, did I get that right? Yes. Okay, with the New York Seed Investment Fund. And Mike Hudak, he's the CEO of Blip, you just raised a third round, right?
Yeah.
Okay.
Yeah.
All right. Well, thanks, guys. So, New York City, we've been talking, we had a lot of the New York City venture capitalists, not a lot, we had 5 of them up here 2 panels ago, and I think Rick Heitzman said from FirstMark that the level of sort of deal flow and activity, he hasn't seen this since, since 10 years ago, since Silicon Alley days. And I've certainly seen a lot, just, companies coming through my office and just the companies that we cover, and I'm based in New York here. The percentage of companies we're covering that are in New York has definitely increased over the past 18 months. And I don't know whether that's just because, they figured out I'm here and they're getting in touch with me, or I think that there's also just a lot more interesting companies that kind of were formed during the downturn because of, they didn't have really high-paying financial jobs, right? What do you tell? Just if we can sort of just come down the line, or start with you, John. Explain a little bit what you're trying to do with BetaWorks, and what percentage of your investments there you consider seed versus otherwise. Is everything seed, or you do bigger investments?
So what we're doing at BetaWorks is we have BetaWorks is a holding company, so we're not a fund, and we have 2 activities. We build stuff and we invest, do seed stage investments, $100,000 first money in seed stage investments. But everything we're doing at BetaWorks is premised on and focused on the social real-time web, and this concept that we see that there's this emerging sort of connected set of companies. Many of them are connected at the data level. As BetaWorks as a whole, we view it as this loosely coupled network of companies. So BetaWorks itself is a company, and then we do the 2 things we do. Why do we do all of this in New York? 3 reasons I'll give you. You didn't ask that, but I assume it's on the title somewhere. So I believe that the big platforms, the big building blocks, and a lot of the hard science of the net has been done, right? From Amazon Web Services to a lot of the search stuff to even to identity, a lot of these pieces are now in place. So this layer of innovation, not all of it, but much of it, and much of it that we're focused on, is at the app layer. It's, I would characterize as lighter weight applications. They can be huge, right? Like I characterize Twitter this way. But they're lighter weight applications, and a lot of the emphasis is on the front end and the design and the UI and the initial experience. So it's sort of, Tumblr, right?
So the hard stuff has to be done in Silicon Valley, but the UI is in New York? Is that
yeah, we outsource that to the West Coast. So that's reason number 1. Reason number 2 is I think that lifestyle. I think that there's a vibrant community of people, everything from the arts to all the way to media, advertising, everything in between, here in New York. And that, I think this round of innovation is, I think, feeding a lot from that. It's also based a lot on it, right? So there's elements of it that are related to the media business, the advertising business, and the like. So So I think that New York is well
But
placed.
let's go back to this. You kind of raised this. You didn't say this, but you kind of implied that sort of the hard technical problems. You're better off doing a startup in Silicon Valley, and then this layer above in New York. Do you agree with that, Chris?
No, I actually think. Can you hear me? Sorry. Well, I actually think, like, for example, if you look at the '90s, the really big kind of heavy iron companies were actually in Boston. The best performing VC of the '90s was Matrix Partners in Boston. So they really kind of built like the optical switching layer. And also, there's also, of course, tons of that in California as well. I mean, my view, I guess, is California is good at a lot of different things. They're sort of good at both the kind of infrastructure layer and also kind of the app layer. I think with New York, like I sort of prefer not to think of it as like a New York versus Silicon Valley thing. I prefer to think of it more as like.
But you always write about it like that.
No, I don't, though. I don't. I get mischaracterized as that. I write about it as I love New York and I love startups, and I'd like to see more startups in New York and less like Wall Street and lawyers and things like this. So that to me is the bad guy. It's not Silicon. I think what I'd like to see happen, I think what John is doing and what we're all trying to do is sort of import the Silicon Valley ethos to New York.
Yeah, we're learning. I mean, we learned so much from the West Coast. I was kidding when I said we're outsourcing tech to the West Coast.
Yeah, and it's this whole like kind of it's played out as like this Biggie Smalls,
Yeah, and who's going to win, East Coast, West Coast?
Well, I think the bigger point is just we pointed this out several times, and if you walked in, you saw the big X over the Merrill Lynch sign. We love the fact that we're holding this conference in an old Merrill Lynch back office. It's like, yeah, we agree with you. We'd much rather see this filled with startups and people who want to create startups than traders. But what kinds of startups is New York most conducive to, or is that the wrong question?
I think it may be the wrong question. I think that the points that you guys are making about the fundamental building blocks being built, there's some validity to that, right? And now the businesses that are interesting, a lot of the businesses that are interesting are media businesses, they're publishing businesses, they're communications businesses. We can stop thinking of them so much as technology companies and start just calling them what they are. We don't need to identify every single type of company that's on the web as a technology company. At Blip, we're building what we call the next generation television network because, NBC debuted at the 1939 World's Fair. A lot of things have changed in the intervening 71 years. We don't think of ourselves as a technology company. We're a media company. We're solving that set of problems rather than a set of technology problems. And New York is uniquely positioned. This is a media town. This is a finance town. There are people here who spend a lot of time thinking about that, whereas in Silicon Valley and also in Boston, there are people who think about optical switching and databases and Hadoop and all of those pieces.
But just because you're an application company doesn't mean that you don't have technology.
Absolutely.
Or just because you're a media online media company doesn't mean that you don't have technology and analytics, and so I agree with you. I think separating out the two, I think a lot of the infrastructure has been built. I think mobile, there's still a lot of infrastructure that will continue to be built, and security and I think Wall Street, or people from Wall Street, from the big banks, I'm seeing an increasing number of them coming out of their own volition to start companies, and so I do think New York's hard technology scene is also growing as much as the application layer.
So there's a lot of people in this room who have startups or have just started them, and they're going to be going through a lot of the growing sort of pains that you've already gone through, especially you, Chris and Mike. What are some of the things you learned, and John as well, building startups in New York City? Where are, like, how do you get, what should you look for just in terms of real estate? And, how do you get a space? Where should you look to recruit people? What kind, where's the best place to recruit engineers versus salespeople? I mean, just give me some, what are the things that you've learned in the past few years building startups in New York City that people can take away?
I would just say a few things. One, I think the whole real estate thing is just a total red herring. If you look at any internet/software company, it's like, say you raise venture money, it's like 2 to 3% of your entire budget is real estate. I mean, basically, what these companies, all of the expenses are salaries for smart people. And by the way, I have investments in Menlo Park, and the the cost per square footage is similar. I think New York is very similar to Silicon Valley in the sense that almost nobody who is working there and successful there actually came from there, right? They're both places that attract people from all over the world. And so, like, we recruit a lot at, like, MIT and, let's say, Carnegie Mellon and Penn and places like this. And you go to a typical college grad, smart college grad, they love New York. This is why New York has been a successful entrepreneurial town for hundreds of years, right? I mean, and not just in finance. It's Domino's sugar and chock full of nuts and all sorts of things. I mean, people like to move to New York, and it's a dynamic, exciting city in the same way that San Francisco is. And I don't know. I mean, I don't know anyone in startups who's a native New Yorker.
Right.
So.
I think that's exactly right, and I think that real estate is relatively easy to find. We found our first office on Craigslist. It was an apartment, and it turned out that the folks who owned that building also basically own the entire block, and so we've been able to grow for 3 years with the same landlord.
From the Craigslist apartment, that's good.
The Trankmans.
Is that how you found your space, John?
We didn't go to Craigslist. We went to another startup that had taken an office that was at a good price, but was bigger than their existing capacity, and they just rented some desks. And we started out at Daylife for maybe the first 6 months or something. And I just saw one of the Daylife guys today. He said that he's got some people in and moving out. So if anybody needs space, I think there's some desks there.
Right.
Look, if you can't sort out the real estate problem, you shouldn't be an entrepreneur.
That's right.
I mean, this should not be a gating factor.
Well, let's get back to the whole seed, kind of rise of seed funds and seed investments. It's like there's more seed investments and professional angel groups or angels that are becoming sort of quasi venture capitalists, and then at the same time you have some of the most successful venture capital funds dipping down into the seed, right? Putting money in a for instance, one of the launch startups here, Fluid Info, right? They did a $800,000 round. You were involved in that, and there were so many, and you were in it too, right, Chris? Yeah. I mean, either of you could have just taken the whole rounds. It wasn't really about the money, but it's like, I mean, it's like what each of you put in $100,000. It's almost just the money, the capital. Like, what are you giving these people? They don't need the capital.
This is something that I think we learned from the West Coast. Chris knows this far better than I do because he thinks about it a lot, blogs about it a lot. But I think we've all been inspired by the West Coast, by Ron over here, by other people on the West Coast who understand the value of syndicates and understand the value of bringing in great investors and people who will help you at different times, at different stages. And so I think that I suspect the market's matured. I mean, I suspect that if you went back to 2000, you maybe have more angels and early stage investors who do really larger bites investments. But now it's becoming a syndicate model, which I think works at the seed stage very well. Yeah. We always invest next to people.
But is seed really challenging the venture model?
I think the VC, a lot of big venture firms are kind of freaked out, basically, because basically what had happened was way too much money so basically, Yale and Harvard were really successful, putting 10% of their assets into venture capital. Everyone else in the world copied it. You had way too much money flow into the VC sector. It sort of worked during the bubble when the public shareholders ended up holding the bag, but then in the 90s when the markets got more rational, it was very clear that you basically had, the good funds, let's say Benchmark went from $80 million to $400 million or something, and then a ton of bad funds got created. And then you had a counter trend, which is that it costs less and less, especially on the web, to create a company. And so you have this thing where people really don't need that much money. You also have, I think, a vastly more educated entrepreneur. Like these 23-year-olds, they come out of Y Combinator and they know every detail of a term sheet, stuff that I didn't know until I was in my 30s or whatever. And they come out and what they think about, and they're smart, is they think about net dilution over time. So they're like, let me do a small round with some value add angels. Ron's the pioneer of this, and John is doing a lot of this in New York, et cetera. And then they'll help me go raise a higher price round later on, and I'll take less net dilution over time. And a lot of the big VCs are realizing, we're basically coming in at this auction stage, not getting a great deal, so let's create these little seed programs. But there's all sorts of, if you read my blog, cdixon.org, there's tons and tons of problems with taking seed money from big VCs.
What are the two biggest problems?
Well, the biggest problem of all is that if they don't follow on, you're basically toast.
Why?
Because if it's smart money, okay, so Sequoia came in and gave you 500 grand, and then now you're going out to look for more money, and you're like, and the first question everyone's going to ask you is, what's Sequoia doing? Oh, they're not participating. It's like the guy who's the smartest investor in the country, who knows you the best, who's been watching you for a year, says, get lost. It's like the same signal as if you, like, I just had a job working for so-and-so. What happened? Oh, I got fired for, it's the same. I mean, it just looks, I mean, do you agree? Do you destroy it? I mean,
Bad signal.
very, very bad signal. So,
I wouldn't take that money, I don't think, unless you had to. And similarly, I think strategic money has the same, it's exactly the same problem. If you take strategic investment from somebody and then they don't buy the company, or even you're talking to somebody else and, they're going to ask, what is your strategic doing? It's very difficult.
Right.
Well, the strategic, I mean, there's some, and I used to be with Intel Capital on the West Coast for a while, so strategics have different strategies, and like, you take a Cisco, and they usually invest to acquire, and there are other strategics that
Why is
are
Intel the only corporate fund that seems to have done okay? Like, what do they do differently?
I think they're very good at testing out the market conditions and reacting to them. There are times when, and they're also good at figuring out where they can add value and where they're just investing to learn a market. So, the way they're structured is affiliated with different business units. And I did enterprise software, which wasn't, as core to the business as a semiconductor investment group. And so we were very clear about what value we're going to add.
So if people have questions, come line up and I'll call on you. But maybe something that'll be valuable for this audience, just like last time. Just to explain, your fund and what you're looking for. Maybe your last 3 investments, just for people to get a little bit of a context. You can start. You don't have a fund, so sorry.
Okay.
All right,
I'll start.
But do you do investing too, or
No, not at all.
No, okay.
I've been the recipient of investing and actually raised a $500,000 seed round probably about 3.5 years ago, and it was a amazingly different climate then than it is now, both in the sense that, we were in between bubbles, really, and it was Founders Fund. None of these things were really around and doing seed level, maybe a little bit. Chris, you weren't doing much here in the city, right? John, you hadn't started yet. And it's really incredible how it's developed over the course of the last few years.
Right, it's nice for entrepreneurs to have options, right?
Absolutely, yeah.
So I'm with the New York City Investment Fund right now, which is a private fund, despite the name, started by Henry Kravis 12 years ago to invest only in New York City businesses. So about a third of what we do is venture. So I joined the group 2 years ago, and one of the first things I did was set up NYC Seed, which is a seed fund, and it was with Polytechnic University and New York State, and it was in response to really seeing a dearth of seed money in New York at the time, which luckily has begun to change with these guys coming into the market, So we're looking for to see the entire ecosystem from seed all the way forward out of our fund.
Chris, can you describe Founder Collective and how that works?
Yeah, so we're a $40-ish million seed venture fund. So it's an actual fund. It's not like a group of angels who sort of. So we there's about 15 million of that is from entrepreneurs and mostly in the local area, and a lot of there are a bunch of people affiliated with it who kind of have the ability to make their own investments through the fund. So we have sort of a distributed model. Kind of the thesis is that we'd rather have entrepreneurs betting on entrepreneurs than having former bankers sitting in an office park, which is kind of the current VC model, which I just think doesn't make any economic sense.
And what's the advantage of that?
Well, I think the advantage is one, so for example, one of our founders is Katarina Fake, who's also the co-founder with me at Hunch. And so, for example, like when she first came upon Etsy, which is now a very successful company, she got involved very early on. I think she came from a perspective, it's like Etsy is like 95% women, I think, and she could see the value there when all the VCs sort of laughed at it. And I think that's I think it's a better model to sort of give a smart entrepreneur with domain expertise a checkbook than to have a banker go and try to read up on a market and draw lines through graphs. I just don't buy it as an investment thesis. And so
I couldn't agree more. Really quickly, we've raised 2 rounds of venture capital, and in both cases led by former entrepreneurs turned VCs, and it's a market marked difference.
Yeah, and I think that's one of the ways New York has changed in terms of the early stage, where 10 years ago you had a lot of hedge fund money and really wealthy individuals doing seed and angel investing, and now you have this second, third generation of entrepreneurs who are doing that, and it's made marked difference in how quickly companies can get to market and grow and bring in other investors.
And you have John, you have an operating philosophy, right? In terms of a lot of the companies that you start you operate. I mean, you're also the CEO of Bitly, right?
Yes.
Yeah. So what's the advantage there?
So our model is a little bit different. I mean, we're not a fund; we're a holding company. The criteria for the investment activity versus building stuff, because when we build stuff, we just figure out something we want to build, we build it. We have some process and some borders around that. But from an investment standpoint, as I said earlier, it's seed investment, first money in. It's got to be a beta, right? Betas work. We want something that we can look and feel and touch. I hate PowerPoint. I don't like abstraction of ideas. I like the real product. I'm a product person myself. I like to use things and get a feel for it. So if there isn't a beta, we're not there yet. We'd love to see some data on, even if it's from 50 users, just to get a little bit of sense of workflow and patterns. And we have a bias towards technology-led companies, which is bizarre in New York, I know, but is more engineering-led versus business. We have a bias towards New York. About 60% of stuff we do is New York, but geography is not a criteria for us. So we've done things in London, we've done things on the West Coast, and so that's sort of. And then you asked me the last three we did was Fluid Info, I think Extension FM, and then no, we didn't do that. And TweetDeck. Which was upping around. So that was the last 2 weeks of activity. So
right, and so we have a question back there. Somebody lined up.
Yes.
Okay.
So you just mentioned geography and investments. Obviously, Silicon Valley, New York City are the big hotbeds. What about these second or third tier cities that are just like a flight away, like Pittsburgh, with Carnegie Mellon there, and I don't know, Cleveland, Washington, D.C., Baltimore. Do you guys invest in any startups in those cities? Are you seeing anybody investing in startups in those cities?
How about Cleveland? Aren't you from Cleveland? No, where are you from?
I'm from Ohio, yeah. The problem is that you need, what often happens is you kind of need a critical mass of a startup community. And so that what happens is that typically when people invest in a place like Cleveland, and this is unfortunate, I guess, for Cleveland, is that they will try to move them to Silicon Valley or to New York or something, because until there's sort of critical mass, it's harder to sort of hire, it's harder to get partnerships, it's harder to, Boston, I think in the 90s, I think it's, still Boston's very strong in biotech and other sort of things, and Washington, D.C., as you'd expect in defense stuff. But there's great companies all over the place, and you can create a great company anywhere. I don't know if there's really.
But there is an argument that you do need a critical mass of talent, capital, and customers, initial customers, right? And it's easier to do that in a larger, not just in a larger city, but there aren't a few places where you have all that combined. And the big thing that you hear in Silicon Valley is that there's people are physically. It's actually not a very large place, first of all, and then you're always bumping into the same sort of people all the time, and the talent pool is very fluid. So people are, there's a greater chance you can bump to somebody who is available to work on your project, and to the extent that can start to happen in New York, I think the better.
When we started Blip, people had exactly the same complaint about New York City, and they said that we had to move to San Francisco. And that was only a few years ago. I don't see any reason why this can't develop in Cleveland or Cincinnati or Detroit or anywhere else. But it does take time, and it takes people who are going to stay there.
Right, and I'm seeing a lot of entrepreneurs from these secondary cities who, and that's going to be offensive to them, but who actually are thinking of moving to New York. So the technology is being created at these universities, wherever there's some innovation. But to really build out the company in terms of the funders and customers, New York has that critical mass. You can get on a subway and go meet with 5 ad agencies or 5 media companies,
right.
and
I think
so
I think it's also important to generalize it. I think look, there's a lot of great stuff that's happening in New York, but there's also a lot of great stuff that's happening in London. There's a lot of great stuff that's coming out of Asia, even out of the Middle East, right? I mean, it's like what is happening is that the wave of innovation from the first 10, 15 years of the internet is now washing through the rest of the world. And major metropolitan centers, where there's critical mass, where there's universities, where there's smart people, where there's capital, where there's talent, and that's what's driving it. So I think it's just the innovation pool is just extending, and there'll be small cities with small hubs, and then there'll be bigger cities with bigger hubs.
Mike, how many of your employees are actually in New York City versus elsewhere, virtual?
Almost all of them. I mean, all of our technology folks are here in the city, and then the sales team is spread across the country and in London now. And then we just opened up an office in Los Angeles, which is content and sales. So the core of the company is definitely here in New York.
Okay. Did you have something you want to say? No. Okay. Question? We have time for.
Thank you for sharing your insights on the new seed programs started by many VC funds. I know it's a new trend, and it's great to hear your perspective. I was just wondering what you think about it being more likely that a VC will follow on if they do participate in the seed round, and that maybe from that perspective you would want to do the seed round since the majority of them do seem to follow on later on, and that they still do seem to add value even as a seed investor.
This is for me, I guess, because I'm the one who talks about this.
No, I guess.
I mean, I don't know. I have to tell you, I've sat in VC meetings and their own investor meetings, their LP meetings, and they very explicitly say we're doing this to get free options. And it's what's called the sunk cost fallacy. Once you've invested the money, don't go throw good money after bad. So if you don't think financiers are clever enough to think that way, it's I don't know. I'm sort of like I began my blog kind of as intending it to. I was going to call it VC countermeasures or something like like all the little tricks I learned when I worked in VC and how to not get sort of caught in them or something. And,
In fairness, I mean, VCs are, they're in business and they want to make money, right? They're not necessarily, it's not an adversarial relationship. It can be good and it can be bad. I've had very good experiences, but the amount of money that they're investing in a seed round, it's a small sunk cost, right? It's an option. It's an option. It's very easy to walk away from that. And I'm not sure that they know you better and they're more comfortable with you. And if the business is going well and they want to continue, they're perhaps more likely to invest in that second stage because they're already in there. But I'm not sure that that's an amount of money that makes it hard for them to walk away in any way, shape, or form.
What I always tell entrepreneurs is that, do as much research on who's funding you and who you're talking to as investors as they do on you, and see how their fund structure, how large their fund is, what their history with their seed fund is. You can get all that information, talk to other entrepreneurs that have been funded by them, and see what their strategy is, because every fund is going to have a different strategy around it.
If I could clarify maybe what I said too, like if Fred Wilson does a lot of diligence and puts in $500,000, I think his intention is to follow on, and like he's done that on I think every case I know of. I think the problem is there's a whole other group of people who literally at a conference will meet somebody for 5 minutes, give them $25,000 out of a $400 million fund, and the person thinks that's great, but it's actually a really, really bad thing, and they will not help them, and then if there is a follow-on round, then they'll suddenly get interested again, and that's what I'm talking about, not people who, I think it's like anything. It's like if they go in and they do some serious work and they put in some meaningful amount of money and their intentions are good, then it's probably okay, and if it's someone playing financial engineering games,
if somebody is, you got a first-time entrepreneur, okay, no track record, comes to you, what are the 3 things you're looking for? Maybe they have a beta, but they don't have like a lot of users. What are the things that somebody has to have done before they come to you as a proof point to invest?
In terms of their experience?
No,
what they're bringing. Look, at the end of the day, a lot of this comes down to the individual their passion for what they're building, why they're building it, their belief in it, their understanding of the product and the market. I mean, just the way they talk about it, right? And you see, I mean, there's a radical difference, I think, between somebody who is thought through a problem very carefully. They've actually had the problem. They're solving the problem because they've had it. And they're trying to figure out how to make that into a business versus somebody who's come sort of top down and said, here's a big market. Let's segment that market and find, a way to find a problem within that market, right? It's people who are looking at problems from the standpoint of the problem, not of the market size per se. Because I think you've got to start off with a real problem, and then you figure out if it's a big problem or a small problem or not.
Yes, somebody once said it's a lot easier to solve a problem that you have yourself, but there are also sometimes businesses where you're trying to solve someone else's problem, and it takes a little bit. Maybe it was you who said it, that younger entrepreneurs are better at solving their own problems.
Yeah.
But sometimes it takes a little bit of maturity or just more research to solve somebody else's problem, like in a market that you could care less about, like auto sales or something.
Dental billing software.
Dental billing, that could be. Okay, well, thank you so much for coming here and sharing it. And I think what we'll do is I'll let you guys go off stage, and we're going to have. Thank you very much. And you're coming back, right? Okay, thank you. So don't go away. Thank you. Thanks for jumping in.
Sure.
We appreciate it. All right. Thanks, Mike. Okay, we're going to start with an award. And this is from what? Right. Raymond